Bitcoin has slipped below the critical $63,000 threshold, once more igniting intense debate across financial markets about whether the world's premier cryptocurrency is on the verge of a massive and painful crash, or if this represents nothing more than a temporary dip that sets the stage for a robust rebound in the near future. As of the latest trading sessions in mid-June 2026, Bitcoin is fluctuating around the $62,800 mark, having endured a sharp correction from its all-time high of approximately $126,000 achieved in October 2025, a decline that has wiped out roughly half of its value and left many investors questioning the sustainability of the previous bull run. This recent breach of the $63,000 level on June 4th triggered a rapid cascade of events that saw prices plummet as low as $59,100 within days, only to recover modestly in subsequent sessions amid exhausted selling pressure, yet leaving the market in a state of heightened uncertainty, where the distinction between a mechanical bounce and a genuine recovery remains blurred. Here at Crypto Hub, we are committed to providing clear, factual, and in-depth analysis to help our audience understand these movements without sensationalism. And in this comprehensive update, we will dissect the recent events surrounding Bitcoin's price trajectory, explore the underlying drivers, examine technical and on-chain indicators, consider expert perspectives, and outline the plausible scenarios that could unfold from this critical juncture in the market cycle, while always emphasizing that participants should conduct their own research and consider personal circumstances before making any investment decisions. The situation intensified dramatically in early June 2026, when Bitcoin broke below the $63,000 level on June 4th, amid a perfect storm of factors that culminated in one of the most severe short-term drawdowns of the cycle. Prices cascaded lower to an intraday low of $59,100 by June 5th, representing a swift drop from levels near $67,000 just days prior. And this move triggered over $3 billion in forced liquidations across derivatives platforms, as highly leveraged long positions were wiped out in a self-reinforcing feedback loop that amplified the decline through automated selling mechanisms. The preconditions for this cascade included elevated open interest exceeding $111 billion, with a heavy skew toward bullish bets at high leverage, multiples of 10 times, 20 times or more, which left the market vulnerable to rapid unwinding when prices began to slip, sustained outflows from spot Bitcoin exchange-traded funds amounting to $4.33 billion over 13 consecutive days, which signaled weakening institutional demand, and a noticeable reduction in the steady buying pressure that had supported prices in prior months, and specific events such as the movement of over 10,000 Bitcoin by the Gox estate to new wallets, raising fears of increased supply potentially hitting the market as creditors received distributions from the long-resolved exchange hack, as well as a modest sale of 32 Bitcoin by Strategy, the corporate holder, formerly known as MicroStrategy, which challenged its long-standing never-sell policy and introduced an element of narrative uncertainty even if the volume itself was relatively small. Compounding these crypto-specific pressures was a strong United States jobs report on June 5th that propelled the Nasdaq 100 index lower by 5%, prompting institutions to liquidate liquid holdings, including Bitcoin, to meet margin requirements in a classic risk-off rotation that demonstrated once again the tight correlation between digital assets and broader technology-driven equity markets during periods of stress. Although Bitcoin managed to claw back above $61,000 by June 6th as the bulk of long liquidations were cleared, allowing for short covering and opportunistic buying to emerge, market observers have cautioned that this recovery appears largely mechanical in nature, driven by the exhaustion of forced sellers rather than the influx of fresh demand or a reversal in the fundamental drivers of the sell-off. The Fear and Greed Index remained mired at extreme fear levels around 12 both before and after the bounce, while exchange-traded fund flows continued to register net outflows without meaningful improvement in trading volume. On the recovery was notably thin, suggesting limited conviction from new buyers entering at these levels. This dynamic raises important questions about the durability of any rebound and whether the market has truly found a floor, or if underlying fragilities could lead to another leg lower should additional negative catalysts materialize in the coming days or weeks, as the absence of a decisive shift in spot demand or macroeconomic conditions leaves the door open for renewed volatility. From a broader perspective, this episode echoes the February 2026 decline, when Bitcoin similarly extended losses, falling below $63,000 to lows around $62,964 before pairing some losses with the move attributed primarily to escalating tariff tensions under the current administration and broader geopolitical risks, including statements regarding potential military actions in the Middle East related to Iran's nuclear program and the deployment of additional United States military assets to the region, which heightened uncertainty and prompted investors to reduce exposure to risk assets across the board. Analysts from major institutions described that earlier February decline as a classic risk sentiment reset and tactical de-risking rather than any fundamental structural exit from the asset class, noting that Bitcoin remains particularly sensitive to changes in global liquidity conditions, where any perception of tightening financial conditions can lead to immediate outflows from risk assets, and this observation continues to hold relevance in the current environment as tariff policies and geopolitical frictions create headwinds that override the intrinsic bullish narratives supporting Bitcoin's long-term appreciation story. The February episode set a precedent for the volatility witnessed more recently and highlighted how external macro factors can dominate price action in the short term, even as the underlying network fundamentals such as hash rate resilience and growing institutional infrastructure through regulated products remain solid. In the June event, the combination of bloated derivatives positioning, crowded long exposure, and sustained institutional outflows through exchange-traded products created conditions ripe for a cascade. Once a catalyst, like the strong jobs data, introduced broader equity weakness that spilled over into crypto, forcing leveraged players out and amplifying the move lower in a manner consistent with historical episodes, where high open interest and leverage have led to sharp but sometimes short-lived corrections. From a technical standpoint, the recent price action has confirmed a breakdown below several key support levels, including the psychologically important $63,000 threshold, and has seen Bitcoin establish a pattern of lower highs and lower lows since its cycle peak, which is characteristic of a corrective phase within a larger uptrend or potentially the early stages of a more protracted bear market, depending on how subsequent sessions unfold and how volume and momentum develop on any recovery attempts. Traders are now focusing intently on the $60,000 area as the next major line in the sand, where a sustained break could open the door to accelerated selling toward the $53,000 to $55,000 zone or even lower, in a worst-case scenario fueled by additional liquidation clusters that remain in the order books and minor capitulation. If prices approach production cost thresholds estimated in the mid-40,000s to low 50,000s, where less efficient operations might begin shutting down and adding to selling pressure from newly mined coins. On the other hand, should prices hold above $60,000 and begin to stabilize, the relative strength index, which has plunged into deeply oversold territory below 30 on multiple timeframes, is flashing classic signals of exhausted downside momentum that have historically preceded sharp relief rallies in previous market cycles, as selling pressure dissipates and bargain hunters step in. Moving averages such as the 50-day and 200-day have likely seen price trading below them, reinforcing the near-term bearish bias, but also setting up potential bullish reversal setups if a sustained move higher materializes and volume expands on the upside, creating conditions where a reclaim of the $63,000 level could trigger algorithmic buying and short covering that accelerates the recovery. In terms of on-chain metrics, the market appears to be in what some analysts describe as a distribution phase, where any attempted rallies are met with selling pressure from longer-term holders or profit takers, rather than aggressive accumulation by new entrants at these levels, although there have been reports of whale addresses increasing their holdings during the recent dip, which can be interpreted as a positive sign of smart money entering at attractive valuations. The overall exchange reserve trends and net flows have not yet shifted decisively toward accumulation, suggesting that conviction remains tentative and further confirmation through sustained positive metrics will be needed before declaring a durable shift in market structure. The hash rate, which measures the computational power securing the Bitcoin network, has shown resilience, indicating that miners are not yet in full capitulation mode, but any further price deterioration could force less efficient operations offline, leading to a temporary drop in security that might exacerbate volatility in the short term, although historical patterns suggest that such adjustments often coincide with local bottoms as the network self-corrects and becomes more efficient. Bitcoin dominance, the measure of Bitcoin's share of the total crypto market capitalization, has likely increased during the sell-off, as altcoins tend to suffer amplified losses in risk-off environments, providing a relative safe haven within the sector, but also underscoring the leadership role Bitcoin plays in dictating overall market direction and the potential for altcoin outperformance only after Bitcoin itself stabilizes and begins to recover. The broader macroeconomic backdrop continues to exert significant influence over Bitcoin's price discovery, with the asset exhibiting strong correlations to traditional risk markets, particularly technology-heavy indices like the Nasdaq during periods of uncertainty, as demonstrated by the June 5th jobs report reaction that saw equity weakness translate directly into crypto selling. Escalating tariff policies have introduced headwinds by raising the specter of reduced global trade volumes, higher input costs for businesses, and potential inflationary pressures that could delay anticipated interest rate cuts by central banks, thereby tightening financial conditions and reducing liquidity available for speculative assets like cryptocurrencies, which thrive in environments of abundant capital and risk appetite. Geopolitical developments in the Middle East, including ongoing tensions surrounding Iran's nuclear ambitions and associated military posturing, have added layers of complexity by threatening energy price spikes that feed into inflation readings and complicate the policy path for the Federal Reserve, creating a feedback loop where uncertainty in one area spills over into others and affects sentiment toward all risk assets, including digital currencies. Despite these challenges, the fundamental case for Bitcoin as a decentralized store of value and hedge against currency debasement remains intact, supported by its fixed supply cap of 21 million coins, growing institutional infrastructure through spot exchange, traded products, and increasing adoption narratives in various jurisdictions around the world. Although short-term price action is clearly being dominated by the aforementioned liquidity and sentiment factors rather than these longer-term tailwinds which may reassert themselves once the current correction runs its course. Market strategists have offered nuanced views on the current situation, with some emphasizing the tactical nature of the de-risking seen in February and its echoes in June, while others highlight the mechanical aspects of the recent bounce as insufficient for declaring a durable bottom. For instance, representatives from investment firms have pointed out that Bitcoin's sensitivity to liquidity means that any improvement in global financial conditions or de-escalation in trade or geopolitical frictions could catalyze a swift recovery, whereas persistent outflows from exchange-traded funds and lack of spot demand could prolong the consolidation or lead to further downside if additional negative data emerges. Other analysts have drawn parallels to historical cycle behavior, noting that mid-cycle corrections of 50% or more have occurred in prior bull markets without invalidating the overall uptrend, and that extreme fear readings combined with oversold technical conditions often mark generational buying opportunities for patient capital, although they caution against expecting immediate vertical moves given the crowded nature of the derivatives market prior to the liquidation event and the need for fresh inflows to sustain any advance. These divided perspectives underscore the importance of monitoring a range of indicators rather than relying on any single signal as the market navigates this uncertain phase where both downside risks and rebound potential coexist, depending on how macro conditions and on-chain dynamics evolve. If the market were to experience a more severe crash from here, several pathways could accelerate the decline, including an escalation of geopolitical conflicts leading to broader risk aversion across asset classes, a deterioration in United States economic data that heightens recession probabilities and prompts aggressive de-risking by institutions further sustained, or accelerating outflows from Bitcoin exchange-traded funds that drain liquidity from the spot market, and potential capitulation by Bitcoin miners whose operations become unprofitable below certain price thresholds, thereby increasing selling pressure from coin production and operational costs. In such a scenario, prices could test and break below $59,000, with momentum carrying toward the low 50,000s or even challenging the $40,000 area in an extreme tail event, although the probability of such a collapse is tempered by the fact that much of the leverage has already been flushed out during the recent cascade, and the network fundamentals, including hash rate and adoption metrics, remain robust compared to previous bear markets where capitulation was more widespread and prolonged. The key differentiator in any deeper downside would be whether new negative catalysts emerge or if the current environment of extreme fear and oversold conditions attracts sufficient buying interest to stabilize prices before further damage occurs. Conversely, a rebound scenario appears increasingly plausible, given the depth of the oversold conditions, the exhaustion of forced selling in the recent cascade, and the historical tendency for Bitcoin to recover strongly from such extremes during ongoing bull cycles, where corrections serve as healthy resets rather than trend reversals. Potential catalysts include a reversal in exchange-traded fund flows back to net inflows, as institutional investors view current levels as attractive entry points, a positive shift in the macroeconomic environment through de-escalation of tariffs or geopolitical tensions, or better than expected inflation data that revives hopes for monetary easing, improved on-chain accumulation metrics, signaling that distribution has run its course. And smart money is positioning for the next leg up and a technical reclaim of the $63,000 level on increasing volume that could trigger short covering and momentum-driven buying from both retail and algorithmic participants. Under this path, Bitcoin could quickly retest $65,000 to $68,000, and if momentum builds, set sights on reclaiming higher ground towards $70,000 and beyond in the coming months as the market digests the correction and refocuses on the longer-term growth drivers, such as network security upgrades, adoption by corporations and nations, and the role of Bitcoin as digital gold in an uncertain global financial landscape. As participants navigate this environment, it is essential to monitor a range of forward-looking indicators, including daily exchange-traded fund flow data, for signs of returning institutional interest, upcoming Federal Reserve communications and economic releases that could influence liquidity expectations, geopolitical developments, particularly around trade policy, and Middle East tensions on chain metrics such as exchange reserves, whale accumulation, and hash rate trends, technical levels around $60,000 and $63,000 for confirmation of stability or breakdown, and overall market sentiment readings to gauge whether fear has reached levels that typically precede rebounds. The current correction, while painful, has also flushed out significant leverage, reduced crowded positioning, and created conditions where any genuine improvement in demand or macro backdrop could lead to sharp upside, while the absence of such improvements keeps downside risks alive in the near term. Throughout these developments, the core value proposition of Bitcoin as a scarce decentralized asset continues to attract long-term holders even as short-term traders grapple with volatility and the market as a whole processes the transition from the euphoric phases of the prior advance to a more measured environment. In summary, while uncertainty remains high with Bitcoin trading below $63,000 raising valid questions about the potential for a massive crash or a strong rebound, the data from recent sessions shows a market that has undergone a significant but not unprecedented correction driven by a combination of leveraged unwinding institutional outflows and macro sensitivities rather than any fundamental breakdown in the Bitcoin network or its adoption trajectory. Both scenarios remain possible depending on how external conditions evolve. But the oversold technical readings, extreme fear sentiment, and historical cycle patterns suggest that the conditions for a rebound are present, even if confirmation through sustained inflows and price stabilization above key supports will be required before confidence fully returns. As always, viewers are encouraged to stay informed through reliable sources, follow developments closely, and approach the market with a long-term perspective that accounts for volatility as an inherent feature of this asset class. Thank you for joining us for this detailed analysis here at Crypto Hub, your trusted source for professional updates on cryptocurrency markets, blockchain technology, and digital finance. We strive to deliver balanced, fact-based insights that cut through the noise and help you make sense of complex developments like the current Bitcoin price action. If you found this update valuable, please subscribe to the channel, like the video, and turn on notifications so you never miss our latest coverage of Bitcoin, Ethereum, altcoins, regulatory news, and market trends. For more in-depth discussions and real-time updates, be sure to follow Crypto Hub across all platforms and join the conversation in the comments below with your thoughts on whether you see a crash or rebound ahead. Until next time, stay informed, stay prepared, and we will see you soon with the latest from the world of crypto right here at Crypto Hub.